Welcome back. You're still tuned into Halftime Report. Let's talk about Smartworks co-working space. That is the first management on the show. Kotak Institutional Equities recently initiated coverage on the stock. They're quite bullish. They believe companies' EBITDA will grow at 38% CAGR during FY25 to FY28, which will be aided by an increase in operational area to 14.5 million square feet. To understand more about their growth trajectory, we now have with us Harsh Binani, who's the co-founder and executive director at the company, joining us now. Harsh, good afternoon. Thank you so much for joining in and wishing you and everyone at the company a very happy new year. The new year started with Kotak releasing a bullish note on the company. So let's talk about that first, because they are expecting a 38% CAGR, which will be led by expansion. What, according to you, would be the triggers for that growth? You recently saw an expansion in Kolkata. Will such cities or tier 2, tier 3 cities would be on your radar? What are the growth plans going forward?
Good afternoon, Sonal and Mangalam. Firstly, a very, very happy new year to you and to all the viewers. 2026 is already off to a great start. And to answer the question around the growth trajectory plan for us, it's very important to talk this new revolution that has happened in India, particularly around managed workspaces. So India undisputably has been at the epicenter of the office revolution in the last decade, particularly more so. This trend has accelerated during COVID. And to put into larger perspective, in the last 80 years since independence, India has produced only about 1 billion square foot of office space, which is just a tad more than New York and London combined. And within this, we know for the next decade, 15 years, another 1 billion square foot is going to get added. So you can only imagine the amount of new office space that's going to come up as India traverses its next trajectory of growth. Now, within the larger frame of office market, managed workspaces and flexible workspaces has emerged as the phoenix in this category. And today, India is the largest market for flexible workspaces globally. More than 10% of commercial RE today is flexible workspaces. And we see this not as a small-time shift. It is a structural shift. It has become the new world order, where you're starting to see a lot of behavioral shift moving towards managed workspaces. So we know for the next decade, not only will a lot of new office space emerge, but majority of it is actually not going to be leased. It's actually going to be managed.
Got that. Harsh, that's a good setup for the industry on the whole. But, if I'm looking at Smartworks in particular, a couple of things stand out. While you came to the street, you were obviously loss-making on a reported basis on EBITDA and the bottom line. The second quarter changed that, where at least on a free cash flow basis, you turned positive. The belief here is that, this is a high operating leverage business. As occupancies increase, as leased space increases, you will obviously see a better up move on your EBITDA from here on. What I'm trying to understand is also the contribution that will come in from ancillary services, because a lot of your peers are looking at premium services just more than, a basic rental that these companies are giving to their clients. What accounts, what's the proportion of that in your overall mix right now? And how is that likely to grow from here? Because that's more margin accretive.
Certainly, Mangalam. So Smartworks has, of course, emerged as the largest player in this segment. As the largest platform today, we manage about 14 million square foot. While the industry has been growing at about 20% odds, we've been growing 1.5 times more. And the primary driver behind this is the fact that we have created this unique differentiation of ours, where not only are we the largest, but we're also growing the fastest. We are adding about 2.5 to 3 million square foot. And our business model is largely focused on getting large enterprises to come and sign up large contracts for a very large duration. So from that perspective, the positioning of our business is more around a REIT-like annuity model. While it's still very early days for us as we're expanding our value-added services and other new avenues of growth, but we still believe that the core business by itself has so much ample runway for growth that we want to continue focusing all our energies on growing this platform. So today we have close to about 14 million square foot with plans to add about 2.5 to 3 million square foot every year. So primary driver for margin upliftment, as I had mentioned during our Q2 earnings call as well, will be the operating leverage and the scale that's going to come from the core business, while all of these value-added services, etc., will be an addition to that, which you will start to see in next few quarters.
Okay, we'll start seeing that in the next 2 quarters. You're also quite confident on the second half, talking about 1 million square feet of additional leasing come by, and there'll be around 1.4 million square feet which will mature in the second half. How long before you get renewals on the leases which are maturing? And also, how confident are you of leasing out the 1 million square feet? Are you already in touch with tenants, or are some contracts already signed?
Look, if you look at our past trajectory, the company has demonstrated very strong growth. We've been growing at more than 40% CAGR for the last few years. In our Q2 earnings call, we had also reported very strong occupancy for our new campuses, while our mature cohort, which finishes about 12 months or so, is standing at close to about 90%. So if you were to look at our past trajectory and the very rapid growth that you're seeing in the company, there is no reason for us to believe that the second half, as we had guided during Q2 as well, where a lot of our portfolio is going to get mature, you will start to see these numbers tick up even more. But the more important context to appreciate here is the fact that the business of Smartworks has been fundamentally a cash flow focused business. So while our EBITDA growth has also rapidly happened, this has happened with cash flow, which is much greater than EBITDA. And that is what makes this business self-sustaining as well. So post IPO, the company's balance sheet has strengthened significantly. So today, while we are net debt negative, but for the future growth trajectory of ours, the company will not require any further capital, and all of that is going to be self-sustained. The 350-400 crore that we've guided.
No, we take that point, Harsh, and I'll just correct myself. Earlier, I said that you turned cash flow positive in the second quarter. It was the first quarter, and thereafter you turned negative in the second quarter as well. What explains that? Point number one. And secondly, from here on a reported basis, what's the annual free cash that you are expecting? And at the same time, when do you, on a reported basis, turn EBITDA and net profit positive?
Absolutely. So in Q2, we had reported the cash flow trajectory of the company to continue to be on the upward trajectory. What led to the metric being smaller than what it was in Q1 is because we are seeing immense opportunity, Mangalam, in terms of growth. So we leveraged Q2 strategically post IPO to block a lot of great supply. As you're aware, our business has been fundamentally built on the foundation of India's commercial real estate, where 80% is non-institutional. And that has been the reason why, through speed and scale, we've really scaled this platform. But the more fundamental shift which has happened in the last 2 quarters is that all the large titans of India's real estate, DLF Group, Panchsheel, Hiranandani Group, they have also now all come to the platform, which indicates to you that even the larger real estate giants now acknowledge and realize that flex space is here to come, and the cash flow that we had deployed to block a lot of this supply, which is now going to go live in 26 and 27, was largely the reason behind why you saw the numbers to be what they are.
Okay. All right, Harsh, always a pleasure speaking with you. Thank you so much for joining us today with the outlook on the business going forward. We'll touch base again when you release your Q3 numbers to be able to give us more numbers in terms of guidance as well. That's the word coming in from Smartworks.